Hello and welcome to another episode of Macro Mondays, being filmed this week on Tuesday due to the UK bank holiday yesterday. My name is James Brodie. I'm Head of Learning Development here at Onyx Capital Group.
And I'm James Todd, Direct Trader here at Onyx Commodities, giving you insight from our trading floor.
Some big moves in the markets taking place. Donald Trump threatened 50% tariffs on Europe at the end of last week, which he's pushed back by 1 month over the weekend. This is causing major moves. He also threatened 25% tariff on Apple for iPhones not produced in the US.
Yeah, on the back of these tariff worries, we're seeing long-end yields showing signs of concern in many markets, and US dollar weakness is continuing as well.
So the long-end yields is probably the best place to start. I think that's the biggest theme in the markets at the moment. Certainly is lots of concern. The US 30-year bond, as you can see here, end of last week, it touched up to 5.15%. Again, a break above there is going to be incredibly concerning. Scott Bessent said he wants bond yields lower, particularly for refinancing, but the market is pushing yields higher. We've seen Leon Cooperman, a famous hedge fund manager, saying he expects the bond market to pressure the US government to address the fiscal deficit. He thinks the market's going to drive yields above 6%. JP Morgan's CEO Jamie Dimons talked about rising risks of stagflation. And just this morning, Fed President Kashkari said the question now is the magnitude of stagflation.
Yeah, it sounds very damning and almost as though, stagflation, which is one of the most concerning economic terms about, feels inevitable in the US.
Yeah. We've had an interesting move this morning, though. Yields are coming lower quite aggressively on the back of the Bank of Japan have talked about moving issuance down the curve. So the issuance will be much shorter duration. So the US yields, actually the 30 yield is 20 points off this peak. But I think that's also a bit of profit taking. I think it's pretty likely we'll get another attack at the 5.15% level. A break above there, then it's just fresh air and the market's going to go one way. I think that's a big concern of the market. If we look at Japan, 40-year yield is now the highest in 20 years. And we had a 20-year JGB issuance last week, which was the worst result since 1987. You can see here the biggest tail here. So acceptance, take-up of the bond was the worst since 1987. Japan's Prime Minister Ishiba's called the situation worse than Greece. And a tremendous fact, an amazing fact, is the BOJ owns 52% of the entire JGB market.
Yeah, I mean, they're the only ones buying anything, it seems. And, I think this speaks to what we were saying before about stagflation, but it's clearly not just a US problem as well. And if you're having, Japanese GDP in contraction, US, obviously huge economy, not sort of firing on all cylinders, etc. Worries with China. I think we're just, entering a period of worldwide sort of economic recoil a bit, aren't we?
Yeah, absolutely. And Ishiba, he said all Japan's GDP is contracting again. Again, it's more stagflation because we had inflation data out of Japan last week, surprise to the upside. Japanese core inflation came in at 3.5% in April. 3.4 was consensus, 3.2 last month. So GDP in contraction, inflation overshooting. And we're also seeing workers at Japan's Business Federation affiliated firms secured pay hikes over 5%. And the chart here is the long bond, the JGB, and you can see just how it's surged higher. But you can see on this morning's news of BOJ looking at shorter dated issuance, means there'd be less supply in the long end. Then we've seen yields come lower, which is a bit of a saving grace in the short term for Japanese government bonds, but certainly concerns in the market. Onto the US, limited data last week. One thing we are seeing, leading economic indicators are contracting again. They've had their largest decline since March 2023. You can see that from the chart. But the flip side, we're starting to see China-US trade picking up again. Shipping rates from Shanghai to US West Coast surged for mid-June. They've surged from $2,200 to $9,100. That's for a 90-foot container. That's since early May, according to Yikai News. So,
yeah, I mean, it's quite interesting this, because of course this is very reactionary to tariff news, etc., and has a bit of a lead lag. But it is looking as though actual business done between the US and China could not be as sort of dramatic and terrible as it was sort of being feared at one point.
Yep. And while we discussed leading economic indicators being negative, they've been negative now pretty much for 3 years, but there's been no recession. It's highly reflective on manufacturing, but it's the service sector in the US that's kept the economy going. But certainly plenty to discuss. Also, talking about US yields, interesting point. Always the market talks about inverted yield curve indicates a recession. But if we look at the chart here, you can see the recessions always come when the curve's steepening. Partly due to the front of the curve pricing in cuts, but you can see here we're entering that steepening scenario. And
yeah, I mean, as you say, over the past 3 years, etc., we've had all of these indicators that show that there should be a recession, and there has been steepening of the curve as well, and yet, things are just seeming somewhat out of kilter with what we've seen historically, because this is quite a nice chart here. It goes all the way back to 1990, and you're seeing this correlation between the curve, flatlining upwards vertically and recessions, but we're still yet to see it. So either the money's on a recession right now and you can sort of really profit off that, or everything that we've seen over the past sort of 35 years of economic data is slightly out of whack here.
Again, unemployment is crept high, but it's certainly not at dangerous levels, just above 4%. That's not a risk. But again, what we will see in the next days and earlier, even 2 to 3 weeks, will be the impact of the tariffs having on the US. China cut the loan rates by 10 basis points last week. 1 year and 5 year loan prime rates are now 3% and 3.5% respectively. Chart here actually back. This is more around the US and global trade. It's the dollar yen chart, a good barometer of global economy. We talked about the key 140 level, and last week it was trending down, but again this morning we've seen a big rally in this. It's been up over 150 big figures. Interesting to see if this morning's move is start, because of course the US was off yesterday as well, start of a retracement from this high yield concerns of the market, or it's just a temporary move. In Europe, France CPI came in this morning up 0.7% year on year. Again, certainly no inflation risks there. And German PPI came out last week in deflationary areas, down 0.9% year on year.
Yeah, it doesn't seem to be quite as significant a worry as in perhaps in the US or even in the UK. The increasing inflation in Europe. There are other issues, of course, ongoing in Europe, but inflation probably isn't at the forefront of policymakers' concerns here.
Yeah, and we also saw weak purchasing managers indexes last week as well. German manufacturing PMI actually contracted to 48.8, and services dropped sharply to 47.2. So we're expecting to see some growth in Europe, particularly Germany, with the huge stimulus package coming through. Not happening at the moment. If we see more of this data, especially with inflation or disinflation, we'd expect the ECB to cut somewhat harder. At the moment, 61 basis points of cuts priced in by the overnight index swap euro area for the next 12 months. The chart here is euro dollar. Slightly different here. I've brought up the 4-hour chart here. So each bar represents 4 hours, and you can see just the quite an aggressive sell-off this morning as the dollar is strengthening, yields are coming lower, Gold is coming lower on this sort of recovery trade from long end yields.
So you might be able to put on a bit of a momentum trade here with that sharp move down.
Yep, and I highlighted on here as well, you can see the yellow line, it's the 8-bar moving average. You can see how that's used pretty effectively by trend following algorithms. Onto US equities. The S&P can't make new highs, even though we've seen more record buying from retail accounts last week. Again, the chart here shows the S&P. You can see the previous highs, the all-time highs. But on Friday or last week, we've hit a peak. We're selling off. There's a bounce going on this morning, but the market's really struggling here, which is interesting because if we push on one more chart, you can see just how expensive US equities are, the S&P. You can see here 12-month forward price earnings relative to the last 20 years. You can see the blue area is the interquartile range. You can see the whole range, and right now we're at the very peak of the range. So again, on these metrics, US equities are very expensive. Retailer buying, I'm pretty cautious here because we can't make new all-time highs.
Yeah, and it's interesting. So two things to pick up on here. Number one, we're at historic levels in terms of price earnings ratios relative to the last 20 years. But as we'd said earlier in the show with the steepening of the 2s, 10s curves, it's possible that what we've been seeing over the past 20, 30 years in terms of economic data may not apply at the moment. And things, ultimately the momentum is keeping the S&P sort of supported here. But in terms of not being able to reach those all-time highs, I do wonder if, as we spoke about last week, pensions being sold on this sort of not quite all-time high, but certainly higher level than what we saw post-Independence Day when there was a huge, sell-off in S&P, etc. I wonder if some people are not even necessarily profit-taking, but seeing this, if retail can take their perhaps expensive in relation to price earnings ratio equities off their hands, I think some people are willing to part ways with it.
For sure, we've seen hedge funds unwinding long positions as well, reducing significantly. And on to Apple. Apple's 25% off the highs, the equity. We mentioned earlier, Donald Trump's come out threatening Apple. It's the first company he's threatened, although they've threatened Walmart, I think, as well, haven't they? Who were looking to increase prices. But here, Trump's threatened 25% tariffs on Apple for iPhones not produced in the US. But here's the chart of Apple, down 25% from the highs. And in the short term, again, you can see from the moving average, in the short term, it's trading down. But the bigger concern, really, if you're an investor in Apple, is if you own the bonds. Certainly the 2.55% 2060 bonds, they're trading now at 54.7. So initially sold at 100, they've lost 45% of their value. So you'd be, again, this is huge concern for the pension funds, the insurance companies, asset managers, real money that will be long of these bonds.
But I think what we've seen here with this sell-off in Apple here, as you said, the individual targeting of firms is something that they're clearly very prepared to do. And whilst, Apple being obviously a huge US tech firm has been targeted with this stuff, my understanding is the Ryanair CEO last week, he was saying that the Trump administration had looked to him to make assurances that he wasn't going to go and start importing Chinese units of planes in his air fleet, which, he said openly on this, I think it was a Bloomberg interview, he said, no, we're, frankly, we're not looking to go and import Chinese aircraft. But of course, I'm not going to make that assurance to the Trump administration. What do I have in this for me? But, it's so apparent that I think the Trump administration are very concerned about where a few things might be going on the individual business basis. And so they're happy to go and try and step in, regardless of how it may appear.
You made a good point earlier saying that, maybe times are different. Equities are at all-time highs or close to all-time highs, but maybe it is different this time. Don't forget, of course, after COVID, we had the biggest stimulus ever. We then had huge inflation, but now we have more uncertainty than we've probably known, certainly since COVID. The Australian Central Bank, the RBA, Reserve Bank of Australia, cut 25 basis points last week. They did discuss whether or not to cut 50. We did discuss 25 or 50 basis point cut. And the RBA governor even talked about the risk of recession. So there's certainly concerns growing in Australia. Of course, huge trading partner of theirs is China, for both Australia and New Zealand. But the economy is looking pretty wobbly there. Australia has 87 basis points of cuts priced over the next 12 months. Interestingly, just across Tasman, 54% of cuts priced in by the RBNZ, both of them terminal rates in a year's time at 2.96%. So that's converged quite significantly. But certainly a lot of weakness in Australia and the New Zealand. We have an RBNZ meeting again this week. Not so in the UK, kind of surprising after the budget, certainly end of last year from the new Labour Party. UK inflation in April jumped to 3.5%, expected to come in at 3.3%. The economy here is strong. Bank of England forecast of 3.4%. The chart here is sterling against the dollar cable, as it's also known in the markets, and it's just trending one way. A bit of a pullback this morning, but the sort of the medium-term trend is clearly, and long-term trend at the moment is clearly higher.
Yeah, and inflation here is slightly higher, obviously, than some of the European counterparts of Britain. But I think this is probably being viewed as a positive sign here, rather than one of a potential stagflation, as we were talking about with Japan and the US as well.
Interestingly, the OAS is pricing 58 basis points of cuts. So the economy seems to be ticking along, but the market's still pricing cuts. So more of that could get underway on going forwards. And on to gold, certainly been a favourite trade of the year. You can see from the chart here, technical analysts will love this. There's a clear trend channel. And again, it's sold off this morning. We're down about 1.5% this morning. Actually, this, from a technical analysis perspective, this is actually a consolidation chart. So you expect to see it, it's consolidating. You'd expect to see a break higher. Again, we've said many times, that's the trade we prefer, being long of gold. Today, it's selling off this morning, but I would look for that. It's about 3,360 level. So we're about 65 points off that, literally in the last 24 hours. But a break above 3,360, 3,365, then expect to see another break higher. And interestingly, with that chart pattern, these patterns typically happen halfway through the trend. So you'd expect to see about, estimating from here, about another 1,000 points higher if it breaks. But again, that's purely a technical perspective, but it lines up with what we're thinking about central banks buying. And of course, if bond yields do tear higher, then where do you put your money? Because the dollar doesn't look attractive, bonds don't look attractive. So then gold will be the next obvious target, along with, of course, crypto.
Yeah.
Interesting point on that with gold. So far this year, gold has had 17 gains out of, 17 of the 22 weeks this year, gold has rallied. So it's been a pretty one-way trend. Yeah,
and it's the sort of thing, as you say, when other asset classes are looking less attractive for long-term investment, perhaps you might miss a bit of the momentum trading side of things that especially technical players are going to be sort of preying on. But as an investment, perhaps it's going to be slightly more stable. Question still becomes, at what point do you enter? And you'd probably rather enter on the mid to low side of this convergence here. But
it's also a good point here. Markets don't move in one direction. They pull back. You have retracements, you have consolidations, you can have a view. And if you stick blindly with your view and you stay long only, then you'll typically get hurt on the pullbacks. And especially if you use leverage and add to winning trades, then you have to be really careful of these pullbacks.
And then, obviously moving on to Brent here, we've seen Brent, it's maintaining its range at the moment, sort of roughly $65, but with sort of a $4 bracket either side of that. And what we saw last week, it was reported that the OPEC Plus were considering increasing output over July. Now, this one of the reasons perhaps cited was to undermine and attack US shale producers, because the general understanding is that with Brent crude below $60 per barrel, it's non-profitable for US shale operators to be producing. So this is a really interesting one going forward. And OPEC, it's very cloak and daggers, and you never quite know what the reality of the meetings is going to be. But if they were to increase output for July, this would have a significantly suppressionary price impact on Brent, sort of all else being remaining stable. But you do still have potential bullish exogenous shocks that could impact things, including tensions in the Middle East, and in particular their influence on Iran, who they're a large crude oil producer. And similarly, Russia, Ukraine, if things escalate further there, you can have surprises to the upside. So it's an interesting one to balance here. And even if you're OPEC and you decide to increase supply, if prices come off and you've undercut US shale operators, then potentially that could be good news as you sort of grip more of the market there. And if you sustain that for a while, either they're going to be loss leading for a while, or they're going to reduce production, so more dominance for OPEC. But similarly, if they increase production and prices rise, well, that wouldn't achieve the shale oil goal, but they're receiving more money for their exact same produce. So yeah, it's an interesting one, and it's hard to exactly know what the next move is going to be, but it seems as though we're going to be in this range for a while. And then secondly, just one to highlight. So this is something taken from our in-house Flux trading software that you can use. So this is the gasoline ARB, which shows US gasoline versus European gasoline. And it's quite interesting because on the back of this tariff news, you might well have expected, European gasoline as it struggles to find more demand, as it would, it's potentially, depending on whether these tariffs, do actually come into play, you might expect European gasoline demand to be falling, and so that would have an increasing price impact on the MoGas ARB. But what you see here is, over the past 5 days or so, even if we're seeing small upticks, overall the move is down. So in that scenario, perhaps people are calling Trump's bluff in terms of the tariffs, or suggesting that the tariffs aren't going to be applied to gasoline. But it's all a bit of a muddy picture, and you could, potentially make some decent money, because if you see, we're in the sort of mid to lower range of the previous month or so. So it's got room to move to the upside for sure.
An interesting point as well, off at a slight tangent, but to do with gasoline. End of last week, BYD have cut prices across their whole range in China by up to 35% on some cars, and they're producing cars as cheaply now as under $8,000. Which is incredible. I went in a BYD car in Singapore last week, first time. I was really impressed.
Yeah, no, they're good.
And that's going to have a huge impact. It's more electric vehicle production and at high quality, but also it's going to have a huge impact on the European car manufacturers that just cannot compete with these prices.
Look, I mean, even if you sort of look close enough here on your commute to work, a large number of the London buses you see now are BYD. And this is sort of something that's crept under the radar a bit, but buses, of course, whether it be diesel or gasoline, they're going to be substituting their demands to electric vehicles. And for all that the politicians sort of love to cite, we need to be protectionist and we need to promote local industry, London buses are now operating on Chinese electric vehicles. It's a fact.
It's unbelievable. OAS pricing for the next 12 months. We've said the Fed, 79 basis points of cuts still priced. Again, the market keeps talking about recession, the curve steepening, but we're not seeing the data weaken yet. Again, it will be the period where the tariffs really start to hit the data should be in the next 1 or 2 weeks. This week's a fairly quiet week for data, but of course next week we do have payrolls. ECB still 61 points of cuts priced. If anything, I would favour more cuts from the ECB than the Fed right now, looking at the inflationary data and the PMIs as well.
It's remarkable seeing the expectations for ECB and Bank of England being, so close together there, despite the very differing inflation data that's been coming out.
That's a great point as well. There's a good trade there to be had as well. And BOJ, the market's still looking for hikes. And in fact, the BOJ may be forced to hike even more at the front of the curve to bring down the back of the curve as well. Something to think about, curve trades there. Last chart to discuss Bitcoin. Again, trading effortlessly higher. Interestingly, we haven't seen a sell-off this morning in Bitcoin like we did with gold. They've been trading pretty much as similar, highly correlated safe haven assets. Again, it's just off the 112,000 high, a break above there. You'll see more money flowing in. Again, if we're looking for safe havens and yields do take off to the upside, typical safe havens of dollar and bonds are no longer attractive. It seems to be gold and Bitcoin. Take your pick.
Well, and from the sort of trend following perspective, even if I prefer gold as a fundamental investment, it seems as though the momentum really is with Bitcoin here. So it might be one to look at if you're looking for some short-term gains.
Absolutely. And I love the moving average charts. It's what trend following is all about. It's what the CTAs use. And you can see it tells you which way the market's going. So what do we have this week? Fairly quiet week on the data front. On Wednesday, French and German unemployment and the FOMC minutes from the last meeting. Thursday is the usual jobless claims in the US. We also have pending home sales. Friday, pretty quiet as well. Tokyo CPI, German CPI. Probably the biggest data of the week, US PCE index, personal consumption expenditure, the inflation data that the Fed like to look at. Interesting to see if we start to see some inflation creeping in there from the tariffs. Also, University of Michigan consumer sentiment. And fairly quiet week. Of course, just to remind you, we do have daily updates, global macro updates on our LinkedIn page, Onyx Institute. And we also do classroom training. We have online training coming out in June. We do classroom training. In fact, I'm in Manila next week with the Asian Development Bank doing training there. So if you're after that, please do get in touch with us. Should be an interesting week watching the yield curves.
Definitely.
Excellent. Good luck. Have a good week. And we'll see you next Monday. Thank you very much.
Thank you.